First of all, we don't have any exposure to Ukraine. We don't have any exposure to Russia. We have a small amount of exposure in some other portfolios, mostly to the aircraft lessors. Those have been in the press a lot as having some risk of losing airplanes that the Russian government decided to hold on to. Initially, there was a lot of concern around, I would just say the market moved to a risk-off posture. Markets traded off. Pretty quickly, that seemed to dissipate, and really I think it was because the market switched its attention from being concerned about Ukraine to being concerned about the Fed and interest rates and what they were doing there. The area where I think that will have really sustained impact is in the energy markets. In Russia, I think exports something like 7% of global supply of oil. There's something of a supply shock going on in the oil market. You had the price of a barrel of oil spike dramatically higher and now has started to come off. But I think that there's some sorting out that needs to happen in that market. We also see an impact in the natural gas market. The natural gas market is not a global market. It's a regional market. And historically, Europe has really relied on Russia for its natural gas, and there's a possibility that they won't be able to procure gas there going forward. And as a result, energy costs have become very high in Europe. So the approach that we're taking to it is a little bit more idiosyncratic to credits, trying to understand if individual credits are impacted by the changes that have come as a result of the conflict. There's some agricultural changes, as I mentioned, there's some energy changes, and really just trying to get at whether or not there's a commodity price exposure that's going to deteriorate the credit, or another element that we need to be concerned about. There hasn't been I wouldn't say a macro impact as a result of the Ukraine-Russia conflict. The other area that I would say that it's impacted our thinking, is that we think it's going to further support a deglobalization trend that we've been observing in recent years, and we think it's going to cause that deglobalization to really continue. We get a lot of questions around an embrace of complexity, and I actually see it a little bit differently. At the most basic level, everything that we're investing in KKC, we're picking because it has durability of cash flow and downside protection. That is our North Star in credit investing. And for part of the portfolio, we do that by making deals with individual sponsors to support their acquisition of businesses. That's the European direct lending piece. And for part of the portfolio, we find, typically in the US, traded credits that are misunderstood by the market. Perhaps they're in no man's land. And for whatever reason, they're out of favor, and we are able to bring to bear our diligence expertise to validate the durability of cash flow and downside protection. And just to bring it to life with an example, we had a big success during the pandemic with a company called Six Flags, which is a US amusement park business. And as you can imagine, when the pandemic started, there was a lot of concern about that business. Effectively, they closed the gates, locked the gates, sent the workers home, and put the business into hibernation. Pre-pandemic, it had been considered a very, very safe credit. And so there was incredible amount of uncertainty. How long are the shutdowns going to last? Does the company have enough liquidity to withstand the shutdown? How much of their costs can they eliminate in order to survive? And what we saw was this low risk, this loan that had been perceived as very low risk, we saw it collapse in price, trade to the low 80s, high 70s. And our analyst on that name, who had been following it in some of our other strategies, wouldn't have been appropriate for KKC, but had been following it in other strategies, reached out to our European private equity team. And the European private equity team happened to own an amusement park business outside of Barcelona. So they were dealing with the exact same issues in a portfolio company. And through dialogue with them, we were able to build a lot of conviction around Six Flags' ability to really cut costs to the bone and really mitigate the cash burn they were going to have during this period of when they weren't able to operate. And because we were able to do that diligence, and because we were able to reach those conclusions faster than the market was, we were able to start to buy that loan before everyone realized that it was actually going to be just fine. They were going to get to the other side, they were going to reopen the gates, and the rides were going to run again. And so I think that just brings to life the type of thing we're trying to do. We're just trying to validate that a business in the case of Six Flags has the ability to survive, that there's sufficient downside protection. There are other sources of value we can rely on. In the case of Six Flags, they own much of the real estate that underlies their amusement parks. And if we can validate that and we can find opportunities where the market doesn't understand and we understand, we can have some really successful investments for our investors. I would say that I think we're really back to a period of more idiosyncratic company selection after a period in the pandemic when there were entire sectors that were really disrupted. And I don't sit here and say I expect that 50% of the dollars that we deploy in the next 3 or 6 months will go into healthcare or IT, or I don't see major disruption in any individual industry that we're trying to chase into. What I do see is a market that is disrupted by the fact that the Fed is changing its posture so quickly and so significantly. And as a result of that market disruption, individual opportunities continue to bubble up in different spaces. I gave you the example earlier of the industrial flow control business. In other circumstances, we've seen some new issue loans that have been coming to market just right at a point in time when CLOs, which are the biggest buyers of loans, have become inactive. And it's these idiosyncratic supply-demand changes that we see really creating the opportunities that we're focused on right now, as opposed to entire sectors that are disrupted or thriving. There are, of course, sectors that are thriving, energy markets thriving. We don't do a lot in the energy space because it doesn't have the core attributes that we're looking for. It doesn't have durability of cash flow and downside protection. The energy businesses typically, when they're having success, the price of oil is high, they take all the money that they make and they try to drill more wells or buy more acreage. So they don't actually make cash. And then when they're suffering and we need to rely on the downside protection, they actually just own acreage, typically in remote parts of the United States. It's not valuable for other purposes. So I would say that I do see sectors that are thriving and some sectors that are suffering. I don't think that that's what's driving our specific opportunities for opportunistic credit right now. I see the primary thing driving our opportunities are supply-demand dynamics that are coming as a result of the banks, as a result of the Fed, as a result of changes in people's posture towards interest rates and the amount of credit risk they're willing to take.